Hi, everyone. This is Tim Melvin with the Tim Melvin Deep Value Letter coming to you from what should be the start of a very busy week for us down here in Central Florida. We're off to some friends' houses a little later today to watch the Daytona 500, which is always a big deal down here. I'm not a huge NASCAR fan anymore, but that is one of the races that's a lot of fun to watch. And after a long, dark winter, even for those of us here in Florida, baseball returns to the field with the first spring training games later this week. You can rest assured, but by this time next weekend, I will have been to at least one ball game down here if I'm really lucky and can sneak out too. Um, anyway, and the other big game of the year, we're still seeing earnings season percolating along here. We're just about through the main part of it. And we're seeing about an 8.3% blended earnings growth, according to the good folks at FactSet. But again, we're still seeing that huge revenue lag. Revenues are only up 0.8% on a year-over-year basis. So we're still seeing a lot of these earnings being achieved through cost cuts, through financial engineering methods in particular, particularly stock buybacks, as management doesn't seem to want to use their cash to expand their business, create any new jobs. They're just buying back stock to massage earnings numbers. Not sure it's a great way to manage your company or the economy as a whole, but it does seem to be the method that's in vogue right now. In fact, looking at the numbers since 2008, we've seen 118% earnings growth in the S&P 500 companies. That's marvelous. That's a huge increase over a relatively short period of time. However, revenues, not so marvelous, folks. We've only seen about 7% revenue total, not average annual, total revenue growth for the S&P 500 corporations over the same period of time. So all of the earnings growth, much of the recovery that we've seen in corporate profits is actually just stock buybacks, laying people off, protecting your profit margins. All that's good and wonderful in a recession, but at some point, in order for there to be a real recovery, we have to start selling more stuff, and some of this cash has to be spent to expand businesses and create jobs, or we're going to hit a wall at some point. Um, the interesting thing, this sector, and again, you see financials are leading the way with 25% year over year earnings growth, but their revenues are actually down 10%. A whole bunch of stock buybacks driving this, credit improvement, reserve releases. Revenues are down, and they're going to continue to be down because there's simply no organic growth in the banking system at this point in time. If you're a regional player and you want to get bigger, you're going to have to buy somebody else, and that sets up a whole new opportunity set, as we've talked about literally hundreds of times in the past. But anyway, if you look at the economic news this week, it wasn't pretty at all. It was yeah, housing starts were down, existing home sales were down, mortgage applications were down. If it had anything to do with housing, it was down during the week. We also saw the Philly Fed, absolutely fell off a cliff this week. Everybody's saying it's the weather. So we'll see. If it's the weather, sometime in the next couple months, we're going to see huge improvements in some of these manufacturing, housing starts, and other productivity numbers. If they don't emerge and the jobs reports that we've seen in December and January are actually the real reflection of what's going on in the economy, we could get a little ugly out here as far as the economic reports. Be great for bond traders, maybe not so good for equity holders. Um, anyway, if you really want to look at the economy and what's going on out there, the disconnect between Main Street and Wall Street's flirting with all-time highs. But take a look at Walmart's fourth quarter report. Their earnings were down more than 20% year over year. Um, this is the fourth quarter in a row that Walmart has failed to achieve same store revenue growth. Now, McDonald's had lower same store sales. Coca Cola had disappointing sales results. So, all these just basic, huge consumer related companies are struggling right now to show any sort of revenue growth because consumers, I think, just based on my experience and the folks I'm talking to out there, are sitting on their wallets. They're being very careful and cautious about how they spend money. When folks are too nervous to spend money on the value meal at McDonald's or go pick up some items at Walmart, people are a little nervous and concerned, particularly after those last couple of jobs reports. Now, I bring all this up because the market is priced for perfection, but a lot of people will accuse me of being too negative in tone when I look at the economy and the markets in the world. And if I'm honest about it, sometimes I am. And the reason is that I don't really ask myself what can go right when I look at the economy and the markets, or what's right with this picture. My first and overriding question at all times is, what's wrong here? I'm looking to find that margin of safety. And part of that's going to come from knowing what can go wrong. What will happen if we bottom fish JC Penney because it's trading below book value in spite of poor fundamentals, and we decide it's going to come back and retail sales continue to fall off a cliff? I'll tell you what's going to happen. JC Penney's is going to go out of business, and if I bought that stock, I'm going to lose my money. I'm not going to be a really happy camper. So I do look for the negatives in the individual companies in the market, and I'm going to talk about those more than the positives. Reason being, if I buy the stock correctly and I've got a margin of safety in the balance sheet and in the asset value of the corporation, going right is going to take care of itself. The upside will be there for me. Buying right is how you defend against all this stuff. But I always worry about what can possibly go wrong. What can go right will definitely take care of itself. Anyway, looking at earnings season, it's the usual silliness, and I'm always just shocked at the type of trading that goes on. You see corporations losing and gaining billions of dollars of market value based on a 1-quarter snapshot of time. If you look at some of the reports from this week, Conn's, the department store, they lost $1 billion in market cap, about 50% of their total value based on a 3-month picture of their earnings. FTI Consulting lost about 30% of their market value. Boardwalk Pipeline Partners lost $3 billion of market value based on a 3-month window and a cut in their dividend. And then you've got Ocwen Financial in the mortgage servicing business that lost about $2 billion based on a 3-month snapshot of the business. On the other side, Green Mountain Coffee is suddenly worth $6 billion more because they beat the Wall Street analyst estimates. Neighbors Industries is worth $1.3 billion more because, now I like that one because I happen to own the stock, because they beat the analyst estimates. This is no way to run a capital market. Okay, the 3-month window is just a snapshot of what's going on, and this trading around the number that leads to increased or falling stock prices is a big reason that we see so much earnings manipulation and financial engineering going on out there. Companies need to step back and take a longer view of the world. However, the upside for that as value investors is that it's going to create some opportunities. Stuff will drop to half of book value because they didn't meet the earnings estimate, in spite of the fact they have this huge pile of assets sitting there getting more valuable by the day. The short-term psychological nature of the stock market does create opportunities. And sometimes people get stupid on the upside as well, and we get an opportunity to sell them some of the stuff we bought cheap at much higher prices. But in general, the short-term focus, both as investors and certainly as the people running these corporations, is not real healthy. Trading around earnings season, I suspect, is a zero-sum game for most individual traders, with a few professionals taking all the pennies. So anyway, we have a huge week coming up next week. We've got retail earnings coming out. We've got Home Depot, Target, the aforementioned J.C. Penney. We'll see exactly how bad things were there in the fourth quarter. Best Buy, I expect they continue to struggle, and they may blame it on weather, but the fact of the matter is their business model's dying and is in quite a bit of trouble. And Kohl's department stores also reports during the week. So it's a big week for retail earnings. Tuesday, we have the Case-Shiller report coming out. We'll see what effect the weather had on home prices across the country. I suspect it'll be a fairly benign report. Anyway, a couple of announcements regarding the Tim Melvin value newsletters. One that I'm really excited about is we've put together a resource center for you guys as part of the Deep Value letter. We'll have the one for banking on profits done probably by the end of this week. This is just a great collection of articles, interviews, free ebooks, all the academic studies that relate to value investing, everything from the psychology of investing to the performance of net stocks. We're going to continue to build this out so you have a one-stop resource center for the information and education materials you need to make yourself a better investor and achieve stronger results over time. We're going to be adding to that continuously. And as I said, we'll have banking on profits up as far as a resource center by the end of this week, I do believe. Anyway, I'm really excited about that because there's some incredible information in there and stuff that I've used over the years to make myself a better investor and achieve stronger results. The other news that I have for you guys, if your primary concern is investment income, we are introducing this week the Tim Melvin value income letter. And this is going to be a portfolio of stocks that uses a barbell approach that I've developed over the years. Higher yielding stocks, including real estate investment trusts, business development companies, and other types of what I call alternative income stocks. Higher yielding, just regular common stocks that we stumble across. They're all trading at low multiples of book value or enterprise value to EBITDA, or one of the various valuation methods that we use. So value first, income second. And the second half of the portfolio is those stocks that are trading safe, cheap, and have a history and prospects for very, very strong dividend growth. So we're trying to give you a high yielding, safe and cheap portfolio, but also has strong dividend growth prospects. That letter will be introduced this week. If you're already a Deep Value subscriber, you know you get access to that portfolio as part of the regular service. But if income's your primary and only concern, it's $199 for the year. Portfolios have done extraordinarily well over the years for people that I've used this approach for. And the current yield of the portfolio is about 7.1%. So that's a little bit better than your average municipal bond fund, bank certificate of deposit, or whatever else you're using to search for income. So this will be, we also have preferred stocks in the portfolio from time to time. So I think this is a great way if you're looking for a portfolio that's both safe and cheap and very high yielding. That portfolio might be for you. So you might want to check it out at marketfi.com. Again, if you already have the Deep Value newsletter, you have that service already. You've got the portfolio information, and you're also getting the regular updates. So another option is just to subscribe to Deep Value, and you kind of get a 2-for-1, as well as this new resource center, which I'm telling you guys is worth the cost of the subscription, in my opinion. I rarely use these little videos as a chance to do any marketing. These are 2 new developments that I think are pretty exciting that you should know about. Anyway, it's going to be a big week. Lots of baseball coming up at the end of the week, and I cannot tell you how excited I am about that. Have baseball season back. The Orioles made some great signings, so I think we're going to be relevant and competitive in the American League East, and that's fun for me. Anyway, I'm off to watch some cars drive real fast and turn left, and we will talk to you next week. Have a great week, everybody.